Philip, thank you very much for joining us. Today what we were hoping to do is get your insights into the A-REIT market and more specifically Charter Hall. So if you don't mind by starting with a little bit of an understanding as to what Charter Hall is, that would be very helpful for us.
My pleasure, Seb. So Charter Hall is an Australian property fund manager. We have about 20.4 billion in assets under management. We're represented across office, retail and industrial with reasonably large weightings to each of those sectors. As a property fund manager, we raise external capital from a range of wholesale, pension and sovereign wealth, along with domestic mums and dads, for the purpose of investing in Australian commercial real estate.
Oh, brilliant, thank you very much for that. And the market at the moment, how are you seeing that market and how is that impacting Charter Hall generally?
Yeah, look, it's a great question. So the market, we access capital across three main forms. Firstly, wholesale space, so that's pension funds and sovereign wealth and the like, retail, which is mum and dad investors, and also the listed market. And it's very deliberate on our part that we attack three different sources of capital because it's unusual that they'll all be firing at the same point in time. And that's the position we're in today. So we've got very strong demand across all three channels of equity sources, which is an unusual position to be in, but it does mean it's a strong and profitable time for our business.
Yeah, brilliant. The sort of bigger, more geopolitical dynamics that are around the globe at the moment, are they having an impact at all?
Look, it's fair to say geopolitics sort of rumbles markets periodically.
Yep.
The good thing about commercial real estate is that it doesn't tend to move as quickly or to be as influenced by some of those bigger moves. Probably the biggest factor affecting commercial real estate today is really bond yields. Yep. And the market's uncertainty in terms of the future direction of them.
Yeah, and that was going to be my next question. What's likely to be the biggest impact in the next 12 to 24 months on the REIT market generally?
Look, I think REITs, by virtue of being listed, are very sensitive to movements in bond rates, by virtue of the fact that bond rates generally form the basis of equity market valuations. And as such, REITs also being seen as a yield sector are regarded as more sensitive to movements in interest rates. Yep. Bonds have obviously moved out a bit from where they were at the beginning of the year. They're still sort of around that 270, 280 mark. And I guess there's a real question about where they go from here.
Yeah, brilliant. Thank you. One of the questions we quite often get asked by our global real estate partners is, do we expect the market to grow or contract in the next 12 or 24 months? There's a real push as to whether or not there's capital seeping out or coming into the REIT market. Do you have a view on that?
It depends on which market you're talking about. Being represented across office, retail and industrial, they all have their own dynamics. From a capital perspective side, we still see strong interest in Australian real estate. And that's really a function of the fact that it's still offering very attractive internal rates of return versus other markets and other asset classes. So particularly offshore capital continues to seek a home in Australia. The domestic superannuation system means that there's always a ongoing demand for real estate as people top up their allocations. Yeah. So that backdrop is still fairly favourable. Within the sectors themselves though, clearly retail, there's some concerns about the impact of Amazon and e-commerce and what that's doing for retail assets more broadly. Yep. But if you look over the last 12 to 24 months, you've seen quite strong asset value appreciation, so cap rate compression. It looks like that is starting to slow. On the other side though, we're starting to see quite strong rental growth, particularly in the office sector in Sydney and Melbourne. So there's a range of factors influencing our markets. From where we sit, we still think it's a conducive environment for further investment into real estate. Yep. And that markets are probably likely to continue on their current path.
Yeah, okay. I think you touched on it just before when you spoke about Amazon's impact on retail. One of the other areas we were keen to understand, I suppose, any operational factors other than capital markets, etc., that are impacting your business?
From an operational perspective, it's fair to say that we look for assets that are resilient, and that's a hallmark of what we try and do. Resilience for us means generally trying to get the longest lease terms we can with tenants. We don't have a crystal ball, we don't know where markets will go, but a long lease that's got an expiry of 10 or 11, 12 years out is pretty good defence against movements in both cap rates and movements in rents over that period. So Long leases with inbuilt escalators is the other thing we're looking for,
Yep.
and that's where there's a guaranteed inbuilt growth. And the thing about that inbuilt growth is that all things equal, that growth in income means that the asset value is somewhat immune to cap rate compression in the market.
Yep.
So that's certainly something we're focused on from an operational perspective in terms of the assets that we try and pick. Yep. And the way we curate the portfolio.
Yeah, and I think you've touched on it by talking about locking in long-term leases, etc. But managing risk for shareholders, as you said, you don't have a crystal ball. Are there areas that you use, that you have control over to help minimise that risk?
The other big thing that we do that probably differentiates us from most other REITs is we have zero balance sheet debt. So we run entirely ungeared. And the reason for that is that as a fund manager, we co-invest alongside our investors in our funds, and the funds themselves have gearing. Yeah. So we have some look-through gearing, but we try and keep balance sheet gearing low, and we think that's a very defensive, sustainable way to run the business. Yep. So very limited balance sheet gearing, at zero at the moment. We do have an overdraft facility which we'll use from time to time to secure an asset, but it's very much we try and reduce the financial leverage because we have a lot of operating leverage within the business.
Yeah, definitely. Do you have a view on interest rates? It's probably a loaded question.
Look, my personal view is they're probably not going high anytime soon. Yep. The trajectory on which they grow, I think, was probably the subject of debate by better minds than mine.
And with the look-through gearing and the entity, or the asset-specific gearing, do you actually try and lock that in, or are you variable?
We're certainly, across the platform, look to hedge out as much of our interest rate risk as we can. Yep. Across the group, we've gone to the US private placement market 3 times in the last 12 months. Yep. As the funds have grown in size, they're now big enough that they're actually able to access capital markets independently. Yep. And our treasury team, again, same as we like to try and get the longest lease terms we can, we try and term out our debt for as long as we can. So nirvana for us would be our lease term and our debt maturity being equal.
Yeah, fair enough. Thank you very much for your time today, Philip. That's been really helpful.
My pleasure.
Thank you.